Blue Oil Corporation stock, ticker symbol OBDC. This stock is up 3% on the year-to-date chart, massively underperforming the overall market, which is up 25%. But investors love Blue Owl Capital for the 11% dividend yield, of course. And to me, this scorecard is looking pretty amazing, but more on that later in the video. First, let's dive into the earnings report to start our analysis. Looking at the recent earnings numbers, we see that they missed on EPS, but reported a beat on revenue. For the upcoming earnings, all analysts expect another miss. Looking at the earnings summary, we see that net asset value per share was sitting at $15.28, down from $15.36 last quarter. Looking at the net investment income per share, we see that this was reported at $0.47, down slightly versus previous quarter. But one of the more important numbers for this company, the return on equity, was reported at 12.4%, which is a great number. Dividends were declared at $0.42, yielding 11%. Taking a quick peek at their balance sheet, we see that the debt to equity was reported at 1.23 times, sitting on the high side of the target range. So that's something to keep your eye on. One of the most important things with these type of companies is diversification. In here we see that the top 10 positions represent 25% of the total portfolio. To me, this is looking really good. The biggest borrower is reported at only 3.9%. Looking at the industries, we see that internet and software is the biggest, with 11.2%. Slightly higher than my maximum cap of 10%, but nothing that worries me a lot here. Looking at the credit ratings, we see that OBDC has B credit ratings. Nothing that worries me a lot here again, but I prefer A credit ratings. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Blue Owl Capital is a 6 billion market cap company. PE ratio is at 9.5, indicating that they are undervalued. Later in this video I will show you my 3 price targets for Blue Owl Capital stock, so make sure to watch until the end. Revenue is at 700 million and in this graph we see that revenue went up in the long run. It has to be said that growth is slowing down, so that's something to keep our eye on. Margins are going up and down a lot, but most recently the trend is going downwards, which is something that does worry me a lot, especially with revenue slowing down a lot as well. EPS is pretty much the same story as the revenue and the margins. It is decreasing, which is not a good sign. Analysis expected EPS is going to decrease from here, which is very interesting. In 2025, they expect EPS to decrease 10%. For the revenue analysis, expect that it is actually increasing in the coming years. Especially for 2026, they have high expectations. Return on assets is sitting at 4.5%, which is a decent number. Return on equity looks really good, which is also one of the more important numbers for this type of company. Current ratio is at 1.28, which is a great number. It also is pretty steady historically, so this looks good to me. And right now Blue Owl Capital has almost 8 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Blue Owl Capital has 426 million in total cash, so they can't pay down a big chunk of their debt. To me, this doesn't look good. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is looking really terrible in the past couple of years. Most recently they managed to report some positive numbers here. Let's see if they can continue doing this in the coming years. Shares outstanding have increased over a longer period of time, but most recently they didn't issue a lot of new shares. So that's very interesting. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 11.3%, which is a great number. Annual payout is at $1.72, and payout ratio is at 75%. I prefer 50% or lower, so right now they have only 25% left in cash to buy back shares, pay down debt, do acquisitions, and all other things. But it has to be said that for companies like Blue Owl Capital it is very common to have a higher payout ratio, given their dividend yield. And now it gets really interesting. The 5-year growth rate is reported at 36%, and they have been growing that dividend for 2 years in a row now. And if you take a look at these numbers, the dividends paid since 2019, we see that Blue Owl Capital did increase the dividends at a decent pace historically. But in 2021 they decreased the dividends due to the lockdown periods. From there they started increasing them again. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. It is coming down, which is the thing I like the most here. And in this graph we see the expected dividends in 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to decrease from here. And overall these dividends look really interesting to me, but how about the historical returns? I decided to compare Blue Owl Capital stock with the overall market, in this case the S&P 500. On the 5-year chart we see that Blue Owl stock was beaten by the S&P 500, and in total OBDC returns 45%. And keep in mind this is including dividends. The S&P 500 is sitting at 99%. On the 1-year chart we see that things are changing drastically, with a 12% return for OBDC and a 28% return for the S&P 500, and again a really big difference. On the 6-month chart it is again the same story, with the S&P 500 crushing OBDC once more. On the 1-month chart it is finally Blue Owl Capital beating the S&P 500, but it is hardly any difference. Bottom line, Blue Owl Capital was beaten by the S&P 500 in the long run, and in the short run it is looking pretty interesting. So could this be the perfect time to buy Blue Owl Capital stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 2, 4 and 6% based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 80, 83 and 86%. For the free cash flow margin I'm putting in significantly lower numbers. For the PE ratio I'm putting in 8, 9 and 10. For the price to free cash flow I'm putting in the same numbers. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. And right now Blue Owl Capital stock is at $15. I hit analyze and we see a lot of green numbers. We have a low price target of $12.5. We have a mid price target of $15 and we have a high price target of $19. And to me the mid price target is the most justified here, telling me that this stock is kinda fairly valued right now. And which price target do you think is the most justified here? Let me know in the comments down below. My final conclusion on Blue Owl Capital is that it is looking pretty interesting. Most fundamentals look really good to me and it seems to be a great opportunity. However, revenue and margins are a big concern to me. And of course it is a high risk, high reward company. This means that you need to check every number from time to time to see if it still makes sense to invest in this company. With a dividend yield of 11%, I think you can't go wrong here. They are also increasing them at a pretty good rate with relatively low payout ratio. And if COVID didn't happen, they also would have a better track record. But this is from a dividend point of view. From a value point of view, things look pretty good to me. I do think they are fairly valued. But as I said a second ago, that is based on revenue and margins to start increasing at a much higher level. For now, I'm skipping this stock and I keep them on my watch list. And of course, keep analyzing them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.